Greetings, everybody. Hope you're doing well. I wanted to touch base with you today about investment planning and retirement planning. It's going to be a pretty short little snippet of a video. I really just want to get across a few big ideas to you. And I feel like a lot of times, just to be honest, right, like the watchability, the tendency of you to actually be able to sit down and watch through something that's just a few minutes might be more important to you than showing you a full length hour-long video. And so today, I'm going to kind of review our investments module. And I want to start the discussion on retirement planning, which is coming up due tomorrow at the end of the day. So as I've been looking through your investments modules, okay, really there are aspects of this that kind of are glaring and important, right? Like we want to make sure that this client is well diversified and that their investment mix is going to provide for them the direction and path for where they're wanting to go. But a lot of times, what we need is a bigger idea behind the scenes, right? An investment philosophy that's going to help guide us through a lot of different client meetings and client relationships. And you're not going to necessarily have that down pat now, but it goes to some bigger concepts that we talk about in the field of finance, right? And many of those has to do with our worldview. Um, and what I mean by that is our investment worldview. As you think about your take on money, its role in your life, it should be guided by things that make sense, right? Like God gave us minds to intelligently understand our world. And He also allows for us the freedom. You think about our investments. To go about making good decisions, right? So oftentimes we are our own worst enemy. We get in the way of things because we deal with money on an emotional level. Sometimes we look at it through a lens of greed, sometimes through a lens of fear. We have a lot of money scripts. Sometimes they're good that we have learned, sometimes not so good, right? But all those bleed into our investments, oftentimes leading us down a path that is not helping us match and align those goals. And most of the time, we as investors, talking about not the planner, but talking about just us in our own personal life, we can be our own worst enemy, right? And so the role of a planner is to help a client by stepping in and helping them, even when they want, because we, at some point, they will all want to make potentially a decision that might be disruptive to their plan. Step in and help them and calm them, and of course, the classic examples are the downturns in the market when things are not uh, markets are going down and people are worried and they want to take action. And for them, if it's just a click away for them to move out of their portfolio in a 401k of stock and into bonds, they might do it. And I've dealt with those stories countless times, right? Where a client comes in and says, "Oh, I'm, piddled with my retirement allocation, right? Like 100% of it in the market, 100% out whenever bad things happen. Try to get back in and time it." And it never ends well. And so as you kind of develop, like as you go back through the investment module, I want you to consider the biggest idea, right? That we need to help a client by defining some things, right? Defining risk. I always use the term most simply that risk is not having money when you need it, right? And so there's a lot of things out there that are risks that are more than just short-term downturns in the market. The biggest ones are inflation, right? The fact that we will see the sustained purchasing power of our dollar lessen over time. And so because of that, we really, really do actually have to invest. It's not an option to just choose to or not to. If you don't invest, then your dollars are going to be worth less at the end of life, and you're probably not going to have enough to make ends meet at that point. That is risk. You don't have those dollars when you need them. Furthermore, another type of risk in retirement planning is when people actually get to the point where they need to start spending from their retirement accounts, right? And at that point, you have to start to begin to dial in a formula, an understanding of being able to de-risk them in the short term. So, all that being said, I'm going to throw up a couple slides for us real quick um, that I use sometimes with clients to help guide this conversation. So, this allows us to just look at and see um, how stocks have done over the long term. Okay. Not really complex. Okay. But a lot of times a client just needs to understand just how well stocks have done. Every once in a while, they'll come to you with these thoughts, right? Like, well, isn't the stock market kind of a gamble or isn't it kind of risky? And to help them understand that over time, right? We do see a steady and consistent march forwards for the market. All right, so this is showing us the 125-year history of the market up 10.1% annualized. Okay. This is showing just the probability of gain in the market, right? So if risk is defined as not having money when you need it, um, a lot of times young people, they'll show up and they'll have a mix of say 60-40, 60% stock, 40% bonds. And I'll have to back them up and say, so why did you choose this? And they sometimes will say, well, I don't like risk. I don't like seeing my portfolio go down. Like, but if you're in your 20s, risk is a good thing, right? Because risk means that you are willing to put money into the market that's going to give you optimal gains over the long haul. And if we zoom out and we go 15 years, we see the probability of the market showing positive returns at 100%. Furthermore, we can expect them to compound 10% per year. Rule of 72 says every 7.2 years, that's compounding and doubling over itself, right? And so to be in a 60-40 in a suboptimal portfolio for a young person is just asking to slow down the opportunity for compounding with no anticipated expectation that you're going to be needing the money, right? Now, once you get within a few years of retirement, okay, usually it's like, at minimum 3, at max 10. At some point, you have to understand, say, risk in the short term is a real potential for the market to show a downturn. Most likely, right, is just going to be a few months, right? Maybe a year, okay, like we had in 2022. Rarely 3 to 5 year downturn. That would be like a Great Recession, okay? And the once in the generation event, okay, where it's actually like more than 5 years, maybe 6 or 7 years, okay, tells us that we do need to create some type of strategy for the goal, right? If the goal is to fund retirement with dollars that we have in a 401k account, then maybe we should start dialing back our market exposure once we get near, really near, to start actually needing those funds, right? And so even though we have a 74% chance that in the 1 year the market's going to be up, the 26% chance that we do have a downturn there is not going to be acceptable, right? And so to take the distribution need from people's accounts out of the stock market and into bonds once they get a few years within retirement does make sense, right? But in order to do that, you can't have a cookie cutter approach to investments, right? And you have to also be able to like coach up and teach up your clients on the proper ways to understand the potential for a return and the potential for loss in the market, how we understand our goals, right? And this is I'm applying it to retirement planning, right? And I hope maybe you could use this in your retirement assessment, but it could also be used for other goals too, right? Like if you knew you were going to save for a car and you're going to need those funds in 10 years, you would start with an all stock exposure. And once you get to year 9, right, you would dial that back because you don't know what that next year is going to give you. Okay, so here's a chart that shows what happens if people get in and out of the market. Um, some people like to do that, right? If you miss just the 3 best days in the market, you've given up almost all of the gains there, right? And so you think about people that do that, right? Like the most recent conflict in Iran. Last Monday got at least a little bit of a reprieve, and all of a sudden the markets were up 2.8%, right? So you take those 3 best days like that day, you go out and you realize, wow, okay, there is potential there that you would have done so much more better if you'd have just stayed put. Okay. Um, and have been invested fully in the market during that whole time. Okay. The annualized 20-year return, okay? This is like the effects of panic attacks on the average investor, okay? And so um, you can kind of read in a little bit on what that's showing, but it's basically saying like um, potentially you're going to find more drawdown in US stocks than other things, right? In the event of a downturn. But in the long run, right, like we do see that stocks typically have a V-shaped return and recovery. Pullbacks are common. We teach our clients expect a 10% to 15% pullback per year, right? And we're not immune to that. But it's just something that you have to sometimes coach people up on when it comes to their investments. This is a wonderful chart that shows the max drawdown from its high in a given year, all right, and where we ended the year. And so look how often you see, say, a 10% drawdown in the market, yet still end up with 20 to 30% positive returns for stocks. Okay. Um, and this again is just showing earnings growth, okay, how the companies have grown in earnings over time. And then this one shows, of course, that sharp rebound that we've been talking about in the market, um, where you give it just a little bit of time, oftentimes things rebound, right? So having some tools in your toolbox, like these charts, obviously you're probably not going to use a chart like this in your presentation, but you sure could reference things like this. Might help you present to the client a basic philosophy and understanding of both investments, and then as we look at retirement planning, helping them figure that out. Um, but it goes to a lot of other things too, right? I mean, you're talking about investments. You ask the question if they have enough or too much in treasury bonds, right? Just paying interest, almost like an emergency fund. Um, you could ask about their approach to, you know, Tesla, ExxonMobil, and those other holdings that they have individual holdings on. Yeah, so hopefully everything is going well for you guys. Look forward to hearing back from you soon. Bye.